I started buying this stock at $63 and change, and it's trading now at $171 and change. I'm talking about PepsiCo. It's one of my buy and hold forever positions, and it's done quite well. It's done even better on a dividend growth perspective because I invest for cash flow, and it's generated so much power in terms of massive dividend cash flow for me. I love PepsiCo because it's a company that just keeps evolving, and today they announced that they're purchasing Siete, which is a really wonderful, healthier option snack food company. And I think this is a perfect addition to their portfolio for $1.2 billion. The reason I'm bringing up PepsiCo, I started buying this, by the way, back in 2011. The reason I'm bringing this company up is it's the perfect example of why I just don't like to make too many changes to my portfolio. When I buy a stock or an ETF, generally speaking, I plan to hold it forever. Investing is like a bar of soap. The more you handle the soap, the less there is. This is a quote that was made popular by VP at Merrill Lynch, Darcy Howe. And I really like this analogy because it relates to my dividend portfolio. I own 37 positions. When I buy, I never plan to sell. And I don't want to trade. I don't want to sell this to buy this, because if I handle the soap, less of it is left. And I believe that not only from a capital appreciation standpoint, but also from a dividend standpoint. The more I'm actively trading or trying to move this to this, the less dividends I will have, the fewer dividends I will have. And so I want to have that backdrop in the video today because I got a question over on Patreon. And this question, and by the way, I'll link to my Patreon in the pinned comment below. The question was around selling. And in particular, the question was, Ian, have you seen IBM lately? Do you think it's a good time to consider selling this thing, maybe redeploying the funds elsewhere? And honestly, there's 3 stocks in my portfolio that all fall into that category of IBM. The 3 stocks are IBM, Walmart, and Caterpillar. There's probably others as well, but those are 3 right now that I generally bought at value levels. Actually, thinking back in time, I bought all 3 at value levels. They have both, or all 3, risen very rapidly over the years, very rapidly in share price. And it makes me think, boy, should I consider selling some of those stocks and redeploying the funds elsewhere where I see more value? Boy, it's such a hard question, and I want to explore that question today. Now, IBM and Walmart, they're tough for me because they've run up in share price, but they're growing the dividends really slowly. And honestly, I invest for dividends. And so this is a perfect case where, boy, I could just sell these things, redeploy the money, and get more value on my money, more yield on my money, more cash flow, which would really help me out. Caterpillar, by contrast, they are growing the dividend very, very quickly. And that's a yield on cost play. So that one's a little bit more difficult from that perspective because it does do the work, so to speak, on a dividend perspective. Whereas IBM and Caterpillar, they're just growing really slowly. Anyway, I thought, hey, why don't I look at IBM today in the video and compare it to Google? Because this is actually a specific scenario that one of my patrons was asking about. Like, hey, Ian, IBM now, it looks like it's valued at the same level almost as Google. Wouldn't it make sense to consider buying the more quality company, the higher quality company? I think it would be very difficult for anyone out there really to argue that IBM is a better company than Google, so to speak. I think it's a great company. I think they're both great. But when they're trading at the same level, would it make sense just to sell IBM and put it into Google or Alphabet? I want to share that in the video today. I did some analysis, and so let's check that out. Check it out on the screen right now. And so first I want to look at some really basic metrics that we've all seen before, but then I want to dig into the cash flows. And I want to dig into a metric that I invented called free cash flow kind of plus. It's a special free cash flow metric that I like to look at. But let's just start. So IBM is on the left, Alphabet or Google is on the right. And you can see, look at that. IBM is trading at $219. Who would have thought? I bought this thing way back in 2016. I started buying it $151 and change. And so I'm up 44.4% on that initial tranche. And I've received a lot of dividends over the years because it's generally been a higher yielding position within technology in particular. Both IBM and Alphabet are trading at price earnings ratios, forward price earnings ratios that are in the low 20s. And so I get 21 for both of them this year. Next year, I get a 20.5 for IBM, but a 19.17 for Alphabet. This is where investors are taking pause and they're looking at these and they're saying, boy, IBM is now trading at the same PE as Google. Wouldn't it make sense to sell at IBM and invest in the higher quality name? I don't know what the answer is. There is no generic answer, but I'm going to share the answer for myself today and how I arrived at my own conclusion. But everyone has a different situation. And so please do keep in mind, I'm not offering any kind of investment advice. I'm just sharing my personal journey here on my YouTube channel. Let's keep going. As you can see on the screen in front of you right now, next, what I want to do is look at the dividends. And so IBM, despite the rally, it is still yielding 3%. Now, 3% is not great. It's lower than my portfolio average, but it gives me technology exposure, which I really lack elsewhere in the portfolio, other than through the ETF SCHD. So 3%, I'd say it's not bad. But Alphabet, boy, at 0.5%, that just doesn't do it for me. It has a very low payout ratio, though, of only 10.5%. So maybe Alphabet will keep growing the dividend over time. They just initiated the dividend only about 2 quarters ago. So it's really a new thing for Alphabet even to offer a dividend at all. And that's why there is no 5-year compound annual growth rate on the dividend for Alphabet, because it's brand new. Whereas with IBM, you can see there on the left-hand side, they're only growing the dividend by 0.61% per year on average. And so I could expect that 3% yield, or the current kind of yield, just to be there. It's a yield on cost. I don't expect it to really grow over time. Starting yield, it'll go down actually over time if the share price keeps growing. And so IBM is a $200 billion company. Alphabet is 10 times its size. And so just off the bat here, when I look at the very basic metrics, it's kind of an easy analysis for my own portfolio. Would I want to sell IBM to put it into Alphabet? Well, maybe if I was way back as a younger investor in my really early days and I had no intention of retiring or living off of cash flow anytime soon, that would be a scenario I would consider more strongly. But for me right now, looking at it just IBM versus Alphabet, I need cash flow now. I'm already using cash flow. I actually use the IBM dividend to pay bills, to help pay bills, to pay for expenses. And so just from a basic perspective, in my personal, very personal situation, which is not investment advice, it's hard for me to make that particular trade-off. Maybe I could consider at some point selling IBM and putting it into something like SCHD. But even at this point, SCHD, it is yielding higher than IBM, and it does have a higher compound annual growth rate. But that being said, I just feel, bar of soap analogy, Ian, don't touch it. Let it do its thing. Don't allocate new dollars to IBM, put it into SCHD, but don't handle the bar of soap too much. IBM, it does play a role in the portfolio. It gives me tech exposure. By the way, I'm doing my best here. It's late at night. I hope you enjoy the video. If you do so far, please give me a thumbs up. It means the world to me. I'm not really going today to try to edit this video much or do multiple rounds of filming. I'm just doing what I can do. I'm doing my thing. It's been very busy lately. And so I'm just trying to squeeze this video in and do my best with the time that I have. But here's where it gets interesting. This is going to get so interesting. So check it out on the screen right now. I actually think it gets even kind of worse on this trade-off between IBM and Alphabet. And this is kind of what sealed the deal. Well, what I already shared sealed the deal, but for other investors, this may really help show that they're not really trading at the same level from a free cash flow perspective, that is. And so the free cash flow estimate, IBM just provided it. 2024, it's 12 billion. Free cash flow basically is defined as operating cash flow minus capital expenditures. Capital expenditures are real money business expenses that companies are investing in property, plants, and equipment. IBM free cash flow 12 billion. What is the price divided by their forward free cash flow estimate? It's a 16.84. Here's the deal with Alphabet. You can see it on the right-hand side of the screen. I couldn't really get a great free cash flow estimate. So what I did is I took Q1, I took Q2 from this year. I summed them up and then I annualized it. And I came with 64.58 billion in free cash flow. And I kind of compared that to 2023. If you look at free cash flow in 2023, it was 69 billion. The reason free cash flow is kind of strained at Alphabet is they are investing heavily, extremely heavily in property, plants, and equipment and investments in the company's future. Their price divided by forward free cash flow is a 34 for this year. And even if I bump up that 60 billion, let's say to 69.5, let's say it's the same as last year, I still get a 29.64. And so you can see here on a free cash flow basis, Alphabet is very different than IBM. And this may be why when we look at them at face value, when we look at them from a PE ratio standpoint, it really looks like, wow, they're trading at the same level. But I would say Alphabet, it's kind of trading more expensive from a free cash flow multiple perspective. That being said, you could make these kind of arguments like, well, at least Alphabet is investing in their future, whereas IBM, they're not investing a lot in CapEx right now. They're not investing as much looking forward. And that's kind of a whole nother way of looking at it. Alphabet will continue to grow quickly. IBM, probably not so much. A tale of two different strategies. But let's keep going. As you can see on the screen in front of you right now, what I really want to point out that's so interesting is you can see now the statement of cash flow. This is the statement of cash flow from Google. And I'm looking back now at 2023 annual report. And what I really want to highlight on here is you can see at the top, net income 73 billion, net cash provided by operating activities $101.7 billion. And so they're having a huge amount of net operating cash flow come through. But check this out. Purchases of property and equipment 32.2 billion in 2023. This is that massive CapEx. If you take the 101 number and you minus the 32.2, that's how you arrive in 2023 at 69.5 billion in free cash flow. But free cash flow, honestly, I think is kind of a flawed metric because it doesn't include a lot of things. It doesn't include oftentimes, or at least in the definition, the traditional definition, it doesn't include interest expense. It doesn't include stock-based compensation. And so just look lower on this cash flow statement. You can see under financing activities that Alphabet is paying about $10 billion a year in stock-based awards. To keep the best talent in the world at this company, they have to dish out another $10 billion a year in stock. That's a real expense. You can see it here on the statement of cash flows. And so to really compare IBM versus Alphabet, what I ended up doing is I invented a new metric. I call it free cash flow plus plus. I came up with this because back in the day when I was learning a program, I learned in C++. And so that was way back in the day. But anyway, I just thought that would be a fun name, but check it out on the screen right now. All right, everyone, free cash flow plus plus. You can see it on the screen Believe it or not, I am refilming this segment of the video. It's the next morning. I wanted to make sure to do this right. I was editing the video last night and it did not turn out on this segment the way I was hoping. I had noticed, boy, I had made an error in one of my calculations, and I cannot have that. I'm a perfectionist. And so this is the life of a YouTuber. It's also the life of a stock analyst. When I'm looking at stocks, creating spreadsheets, doing analysis, this is what it's all about. It can be iterative. There are mistakes sometimes, and we have to look at our numbers a bunch of times. And I'm sure that's how it is for all of you at home as well. And so don't feel bad about it. Just keep fine-tuning the models and doing your best. But free cash flow plus, why did I come up with this metric? I came up with this metric because I see shortcomings with free cash flow. Free cash flow is defined as cash flow from operations, and then it subtracts out CapEx. So if you take the first two rows of numbers in this table you see on the screen, that's basically free cash flow. I could take the cash flow from operations and I could add in the negative CapEx because it's negative here, it's subtracted out. The first thing I want to point out is Google on the right. Wow, look at that CapEx. It's massive. It's $32 billion. It is quite a bit larger than IBM on the left. You can see, again, a tale of two companies. A company on the right that is investing for future growth that probably could generate more current cash flow or cash flow plus, but they're not. They're reinvesting towards growth. But then you see a company on the left that, yeah, they're investing towards growth, but it's really a cash machine. They are just generating cash right now that can be distributed out as dividends for shareholders. And so it's a tale of two companies. I like both of them. I think they're both amazing companies. They play different roles. IBM is the one I own. Okay, but what is the shortcoming with free cash flow? And this could be applied not just to Google, not just to IBM, but to other companies as well. The shortcoming is a lot of companies, especially tech companies, are paying stock-based compensation these days. Stock-based compensation, it's not really factored in to the free cash flow, to my knowledge. And it's a real expense, though. I saw this further down on the statement of cash flows, for example, that Alphabet provided in their annual report 2023. This was the cost. It's further down on the cash flows. And it was almost $10 billion. Alphabet is paying a lot of money on an annual basis, and it was about the same amount for the last 3 years, for 21, 22, and 23. Each year they're paying a lot of money to retain the best talent. Hey, IBM is doing the same. They're paying $843 million in stock-based compensation. That's what the 2023 annual report showed, but it's not the same as Google. Google, wow, it's a lot more. Another thing that is not included in free cash flow is debt service. But I have a note here at the bottom. I'm looking at cash flows today, and in some ways, maybe the cash flows for IBM are superior, the statement of cash flows, just from the standpoint of a dividend investor that uses dividends right now. When I look at the statement of cash flows from IBM, for me, it shows a company right now that is at kind of peak cash generation, and it can just pay that all out as dividends to me. And I like that for someone that uses IBM's dividends right now. I'm not reinvesting. But the note I have here is the balance sheets, they don't even compare. Google crushes IBM on the balance sheet. I have to factor that into my free cash flow plus analysis. And the way I do that is I just want to look at debt service. How much interest are they paying? Well, IBM is paying $1.66 billion, whereas Google's only paying $308 million because Google has a stronger balance sheet, a much stronger. It doesn't even compare. Boy, I don't think I've seen too many balance sheets the way that Google's looks, or Alphabet, I should say. I have a force of habit. I keep calling it Google from the olden days. And so anyway, what is free cash flow plus? Well, all it does is it takes free cash flow, which is the first two rows, and it sums in the negative stock-based compensation charge and the interest expense on the debt service, basically. And what you can see is it kind of backs into what I look at as free cash flow plus, which is what I'm really looking at, real free cash flow. What's the real free cash flow that's left to pay dividends, to do stock buybacks? Well, with IBM, it's $10.175 billion. With Alphabet, it's $59.3 $350 billion. And when I look at this, the kind of the price divided by the free cash flow plus, the way I actually back into that is I just looking at market cap. And if I look at the market cap divided by free cash flow plus at IBM, I'm getting a multiple. It's trading at a multiple of 19.86. Whereas with Alphabet, it's trading at a multiple of 34.71. Now, the argument you could make here is that, well, Alphabet is investing for the future. Over time, they could probably ratchet down CapEx and they could have a better free cash flow plus multiple. I'm just going to run a scenario here. Let's say they bring this CapEx down to 10 billion. If they do that, the multiple drops down to 25. And so that's getting a lot closer to IBM, but they'd have to basically cut away 2/3 of CapEx just to get down to a price divided by free cash flow plus of 25. And so it just goes to show there's quite a magnitude difference there. But again, it's a different strategy. One's not better than the other. Most would probably argue that Alphabet has a better strategy for the long run, and they're probably right. But again, for me, where I sit with my financial needs, this is why investing is so personal, I'm just going to hold on to my IBM. Now, I want to compare these. What happens? When we looked at the multiples before, just price divided by forward free cash flow, I was looking at a multiple of about 16.84 for IBM. So free cash flow plus kind of trued up that number. That number's closer to 20. And with Alphabet, it actually stayed pretty similar. Their price divided by forward free cash flow is about a 34. And I'm getting about the same, honestly, when I look at the price divided by the free cash flow plus. The reason for that, honestly, is when I was looking before, I was looking at a forward free cash flow estimate, whereas the free cash flow plus is backward looking. It's on 2023 numbers. And honestly, 2024, I couldn't get a great estimate of what free cash flow would even be at Alphabet. I think directionally, the numbers just show, hey, Alphabet is more expensive on a cash flow kind of multiple. And so that's my fun free cash flow plus analysis for today. And now I'm going to get back to editing this video for all of you. For me, as a value investor who relies on dividends, who needs cash flow now, who needs it right now, I just can't, for my persona, make the choice of selling IBM for Alphabet. Alphabet is a real play on the future, on looking many decades out. I would say not even 1 decade. We're kind of looking 2 decades or 3 decades out. The yield on cost at that point, there's no question. It's probably going to beat IBM. I don't see IBM growing quite a bit from here. Alphabet, boy, I see it growing a lot. And so I could totally see how other investors would have a very different view of the same comparison. And that's why investing is so personal. And I'm just investing for cash flow. But the other thing that this analysis told me, going back to the bar of soap, of course, I'm not going to sell IBM for Google. I was thinking about it though, but what would make more sense for me would be to sell IBM for SCHD. But the reason I'm not even going to do that is when I look all the way at the bottom of this free cash flow plus analysis, I'm kind of seeing, well, IBM, hey, it's still got some value there. It might not be readily apparent through the PE, but when I look at it, especially as compared to Alphabet, I'm seeing, wow, IBM, it really is a cash flow machine right now in the present day. Will that cash flow grow a lot over time? Probably not. But it's a cash flow machine right now. And that's what I need right now. I need a cash flow machine that will throw off a lot of dividends. And yes, they're not growing the dividend very quickly, but the dividend is well covered. And the dividend is something they probably could grow over time if they wanted to. And I think new management, new leadership at IBM is doing a fabulous job of managing that company. So hopefully I got a little more technical today. I haven't done that for a while, but I wanted to get a little more technical because I thought it would be fun for all of you at home just to see how I look at things. Because as you're looking at stocks, you're looking at other stocks. Maybe you're looking at Walmart or Caterpillar or PepsiCo, something completely different. You could maybe look at it through this lens. It might give a new perspective on the investments that you're looking at, but I haven't dug down into the statement of cash flows for a while, so I thought it would be a lot of fun. Before I go though, I have a summary, as you can see on the screen in front of you right now. I want to share just some takeaways from my analysis. And so the first thing that I'll say is I still see kind of right now in the present day more value with IBM than Google. I think Google is far better, Alphabet I should call it, for long-term growth, far better. I think IBM is better for income right now. I like Alphabet's balance sheet better. I don't like selling. I'm just going to hold. It's always difficult. It's difficult with these types of stocks, especially when they've rallied. I liked IBM when it was trading at $150. I don't like it as much now when it's over $200, but I guess it's finally had its time. With that, I have some more thoughts. And so this is just kind of Ian thinking in real time. There's a lot going on in our world right now. And so I want to leave you just with some closing food for thought. I love seeing you all in the comments below. Please comment on everything I shared so far. I'd love to know what you think about it. Which one would you pick, IBM or Alphabet? And also, that's question one. Question two for all of you is, do you ever sell stocks that have run up a bit, like Walmart, that have lower yields and redeploy into stuff with higher yields, like SCHD? Or even PepsiCo, put it in the comments below. But the third thing that I just have on my mind right now is, hey, East Coast of the US right now, the ports are on strike. And so I'm sure you've seen this in the news. I don't want to take sides. I have a side on what's going down right now, but I try not to just share that stuff here on YouTube. I don't want to get political or take sides, but I want to look at things pragmatically, what's happening right now. Well, if this strike goes on for a long amount of time, we could expect, again, some shocks hitting the supply chain, kind of like they did during the pandemic. And we've seen that these supply shocks in the past, like with the pandemic, they affect the availability of goods. And oftentimes they can kind of be the beginning of inflationary times. And it's interesting because the Fed just cut the Fed funds rate. And also over in China, it seems like they are implementing some economic stimulus as well. Asset prices are increasing right now based on that. It does seem here like we could be headed for inflationary times again. And so it's so interesting, though, when I look back in time at something like IBM. Yes, it's gone up in price. It has created value, so to speak. But I also think the value of the dollar over time, it's going down. And it seems to be going down at more rapid pace. And with things like this longshoreman union-related strike, if that were to go on for a long amount of time, it kind of seems like, boy, could that be the beginning of more inflation to come? And then you start thinking about your investment strategy and your investment portfolio, and you're kind of pat yourself on the back because the asset prices are going up. And you pat yourself on the back because the dividends are going up. But you start thinking, hey, it's worth more dollars, but what's the purchasing value, the purchasing strength right now of the dollar? Well, it's gone down quite a bit. And so that's just something that I think of in my mind as well. When I'm looking at all of this, I'm like, wow, IBM's gone up, but has it really gone up? Is what it's worth really worth more in purchasing power than it was before? The jury is out. The way I look at things is I try to fix any kind of expenses I can as best as I can. I try to minimize expenses. I try to look at geo arbitrage. We moved. I live here now in Idaho. I love it here. Our whole family loves it. It's been great. But dividend investors, we have to be really savvy about these things. We can't live in a fantasy world. We live in a world that has had inflation, that will continue to probably have inflation. We live in a world right now that has a lot of ups and downs. And so it's not just about growing the dividend income over time, because even as that income grows, it may have not as much purchasing power as we all think. And so we have to get clever about our strategies in life that revolve around fixing and minimizing living expenses the best we can. But if you have any thoughts about that, put in the comments below. What a crazy time. But I try to take the best news of the day out of all of it, which is this. I love you, PepsiCo. Thank you. Anyway, if you enjoyed the video, please go ahead and click the like button. It means the world to me. Please also consider subscribing to my channel. I really appreciate everyone who subscribes. It means the world to me. Before I go, in terms of a full disclosure, I am long the stocks mentioned today. I am long PepsiCo, ticker PEP. I am long IBM, ticker IBM. Walmart, ticker WMT. Caterpillar, ticker CAT. Also, I am long SCHD. Before I go today, in terms of a friendly disclaimer, today's video, it's not investment advice. I'm not a licensed investment advisor. I'm just sharing my journey here on YouTube for fun and entertainment. It's possible to lose money in the stock market, so please do consult your licensed financial advisor before making any investment decisions. Also, as always, in the description below, I have additional disclosures and disclaimers. I love you all. Thank you for watching the video, and I'll see you in the next dividend stock investing video.